Now, what are the benefits of buying a company that is in distress, and what is the increased risk in doing so?
Purchasing a company that's in distress represents the opportunity to buy the assets at a discounted price. And in this economic environment, in many countries, such as the UK, companies are coming under increasing pressure financially for various reasons, including the higher cost of financing. Of course, the vendor may not inform you that the company is in distress. So as part of every legal due diligence and financial due diligence, one is assessing this. But there are going to be signs which we'll run through of underperformance. And if the company is in some sort of formal insolvency process, then that influences the transaction and indeed the due diligence itself. Let's take an organisation that knows it's in distress. The first stage is where it's looking to turn itself around, and that's going to be by improving its processes or its investment. It might need further investment. And this is where the investor is being brought into the scenario, either wholly to purchase it or to come in as an additional investor. And so organisations such as Turnaround International, TMA, they operate throughout the world to assist organisations that are looking to turn themselves around. We work particularly with the Indian chapter of TMA, and increasingly foreign investors are working with such organisations to identify opportunities for investment. And this is where we provide such investors with legal assistance through structuring a focus on the reasons that they're looking to invest, and then to bring a due diligence discipline from a global perspective, which can then be applied to the individual legal jurisdictions for each relevant country. So that's turnaround. Then you've got business rescue, which is where an organisation is failing and is going to need to restructure its debts or its assets. This is really where it's selling off its assets. It's going to be giving an opportunity to buy assets. If you are buying assets from a distressed company, you want to make sure that you're getting good title to them. And this includes whom you're buying them off. Because if it's then moving into a situation where it's been put into administration or similar, then you have to make sure that the administrator that you're buying the assets off has been validly appointed, and there's no obvious challenge to their appointment and what they're doing in selling. That leads us on to workouts or schemes of arrangement, which is the more common term in the UK. So this is where the company is making arrangements with its creditors. It's often with the sanction of a court, which will stand still the creditors from bringing further claims against the company, while it gets itself into a situation where hopefully it can continue to trade through reorganisation, including new financing. But finally, you're getting to the death knell, where the company has put itself into voluntary liquidation, or the creditors, one or more of the creditors, put it into liquidation. Or, as I mentioned earlier, the company's been put into administration, where the government has put in place a process where a company such as Wilko recently can stay any action from creditors while an administrator is appointed, to give them a chance to reorganise the entity, to stabilise it, to see whether its operations or its finances can be improved so it can continue to trade. Or if that can't be done, as we saw with Wilko, it's put into liquidation. The other example I should mention is receivership, where a particular creditor, such as a lender, that has security over the company's assets, has the right under its documentation to appoint a receiver to take over those particular assets and manage them, including to sell them. When one is coming into the situation as a potential buyer or investor, And Robert, this is something that I know that you always focus on. A key question is whether the target has crossed the insolvency Rubicon.
Yes, of course, that is always a problem because basically only the directors know that. And the law is quite clear on directors' responsibility. And I think this is what you're alluding to. If the directors are aware of the fact that they can't pay off all the company's debts as they stand within a fixed period as prescribed by the legislation, they have to seriously think about putting the company into liquidation. This is not much help to you if you've been buying assets of a company only to find the directors one day say, I'm sorry, we've been advised by our lawyers that we can't continue to trade and we're putting the company into a voluntary or worse. We're asking for the official receiver to step in and we're putting the company into compulsory liquidation. End of transaction.
Exactly. So when one is approaching any organisation that's in distress, one needs to be getting an understanding of where in this cycle it is. But of course, if the vendor hasn't referred to its distress, you need to identify it through the warning signs of underperformance in any event. And I'm just going to run through the sort of list of things that one might be looking for. So have there been any winding up petitions in the UK, the Companies Court? One would be looking for lesser signs such as late accounts being filed. Why have they filed their accounts late? Quite possible because they are negotiating with their auditors, because their auditors are saying, I'm going to have to put a qualification on these accounts that you may not be able to operate continually as a going concern. Has there been increased parent company support? So at the top of every group of companies is a parent, and its subsidiaries, when they're trading with third parties, may be asked by those third parties where they're concerned about the financial strength of the subsidiary. For parent company support might be through way of a guarantee or some sort of letter of comfort. Directors' resignations, sinking ship and all that. Director appointments, the banks appointing somebody to come in and oversee the company. Is the shareholder stepping in to appoint somebody who's going to run that organisation through to a sale? The accountants, when they're doing their due diligence report, are going to be focusing on the accounts, but we always will look through the accounts to see other signs such as assets exceeding liabilities, whether there have been recent disposals of assets or companies. One's also looking through industry knowledge of a decline in that company's reputation in the market. Markets talk. Coming back to the accounts, falling gross profits, things such as stock. Are stock levels rising because they can't sell? Have their debtors risen? Has the company factored its debts? And this is something that will often be disclosed at Companies House under a mortgage register. Intragroup liabilities. So have they been writing off liabilities in order to improve their financial performance? Gross profits, margins, have they declined? Operating profits fallen? Are they continuing to just rebrand and relaunch the same old products? Because it's no good buying a company's products that are failing in the market. Staff morale. How can one find out about staff morale? Is it dropping? Looking at data such as resignations and so on. Trade union activity, grievance procedures instituted by employees. But if one can meet with staff as a buyer, which we've always tried to do, that's when you get the real gold nuggets of information. Where the company's failing to meet its liabilities to its contractual parties, are its suppliers starting to limit the credit that they'll provide? Again, this is the sort of thing that will seep out into the market. We always try to work closely with industry specialists who know that market. Is the company starting to change the way it's handling its payments? Are they paying slower? Are they starting to challenge the suppliers' invoices? These are often just tactics to slow down the payment. There was cases in the early 90s in the UK during the property crash, where insurance companies that were paying out mortgage indemnity payments to banks were under so much stress that they were having to limit the amount of claims that they were paying to the banks. Even major organisations can find themselves in difficulties, and we mustn't forget this, how the mighty can fall. Refinancing, departure of key employees, particularly senior employees, creditors starting to make claims. So it's always important to search any county court and other court records to find whether there's increasing transactions and claims.
If I could just interrupt there, Christopher, you were talking about employees. I mean, this is a major factor which we see in modern business. A few decades ago, when you and I started, most companies had good balance sheets with lots of hard assets on them. Now we're talking about employee-heavy businesses, particularly in the IT field. These people have few assets, and if they have assets, they are mostly electronic equipment, which doesn't go for very much money. The key asset is the employee, what he's got in his head. And we've seen so often in the past, and it occurs across all these companies who depend not upon the machinery bolted to the floor, but the information bolted in the employee's head, how a company can very soon collapse if the employees walk off. And we've seen the piracy that goes on with the attraction, and it occurs across the board. Even law firms have become susceptible to this. Whole teams have gone and taken with them a large chunk of the business. And this is very difficult to detect. It's quite easy to walk around a factory floor and put a value on the assets. And you can look at the employees, and you really don't know whether they haven't been approached the previous day when the word has got out and they're about to drift off.
This sort of situation where a company's in distress will, of course, increase that even further. One is looking to understand where in the process the company might be in its distress, if it's declared in distress. So, for instance, where it's already moved into administration or under the control of an insolvency practitioner, one is needing to look also at the appointment of that insolvency practitioner, where they are in the process. For instance, if after analysis they've determined that they're going to have to start to sell off assets, have they presented their plan for restructuring to the creditors? Is there the necessary support as required for that process? Because otherwise, as buyer, you could find that your acquisition then comes under challenge. Has the company moved into a prepackaged administration, which has been presented to a court or otherwise? Are any of the assets subject to a fixed charge that could be the subject of a retention of title? Because if you're buying that asset and there's a retention of title placed on that by, for instance, a financier, then you don't get good title to it necessarily. These sorts of additional due diligence assessments need to be made according to the process and the relevant country. And so that's why we work with lawyers that have experience of insolvency in each country when one is in this situation. So in summary, the opportunities are increasing as various economies come into distress around the world. It's really a matter of determining as a buyer their appetite for risk and the potential opportunity.
That was a very detailed and comprehensive answer. Thank you.